Hey, this is Justin with daytradethemarkets.com, and in this video I want to talk about what I call box theory. Talk about what boxes are, why they matter, and how they can help you make better and smarter trading decisions, which obviously lead to better results. So first off, let's talk about what boxes are. In a nutshell, they are a tool or a strategy that I'd love to teach you. What happened is that over time, as I became more and more experienced as a trader, I understood, you know, theoretically the natural flow of the market, and I wanted to find a way to see that a little bit more clearly, or make better sense of it visually, if you will. And I'd certainly done fine prior to developing these boxes, but what I found is when I put these box rules together and used them day after day after day, the market became just exponentially easier to make sense of, and then obviously by extension, I started to do better as well. And really found them to be a breakthrough in my personal trading. But what happened is I taught this to a few other people who asked me to do some one-on-one coaching, and same thing applied. They kept telling me time and time again that, boy, they've never seen the market more clearly than this. It really helps frame everything. It just made a world of difference. And so that's what you can learn if you'd like. Essentially, boxes do many roles, but essentially they simplify the trading day. And so you've got a picture there. If you're a 30 Rock fan, there, Liz Lemon shotgunning a pizza, an entire pizza. But traditionally speaking, if you will, you don't shove a whole pizza in your mouth. You break it into smaller pieces. That makes it a much more effective method of eating. It's more digestible. It's a lot less messy. Again, you break it into smaller pieces and it just makes things simpler. And it's the same idea with the boxes. And another way I think about them, another illustration, if you will, is you kind of change the boundaries of the playing field throughout the day. So if you look at the image on the left there, it's I think it's in Minnesota. They have a big pond hockey tournament. Think of this big lake here as the whole day, the market as a whole, the whole day. What we want to do with each of these boxes is we take this big lake and we break it into smaller, in this case, hockey rinks, and it's just giving us a smaller playing field. We can actually make sense of that now. We have a playing field, and think about each of these little ice rinks as a box. Now, once we get inside of the box, then we make our decisions. That's where we're kind of at ground level, if you will. We're trying to make our decisions. We're trying to ID trades. We are scoring trades. We're managing trades based on what this evidence is telling us. And the way I think about this, again, I like to say this idea of win the box. In other words, we have a box. We've made it simpler to make sense of. We're not trying to make sense of the entire day as a whole. That's overwhelming. What we're trying to do is make the best possible decision we can in this particular box, which is the one that's active at this given time. Now, that may be to take a trade. That may be to pass and wait for more evidence or another box to form. But the bottom line is, if we can make it a simpler playing field, we have a much higher chance of success. We're not trying to, tackle the entire day at once. We're trying to just win the box, okay? Now, another way of looking at boxes is that they help you make sense of the structure of the day. And there are a couple different ways you can do this. Think about the micro level of making sense of it as an individual box. Okay, this is I guess I was hungry when I did these slides. Pizza and the hamburgers here. Each of these individual pieces as a box, they come together to form the whole hamburger, or cheeseburger in this case. And the idea is on the macro level, it helps you make sense of the day as a whole. This is the micro level. We're trying to make sense of the boxes individually. So let me start by looking at it kind of on the macro level, the bigger picture, making sense of the day level, if you will. And the way that I think about this is that, and the way I've thought about trading for a while now is that the market is always giving away clues. It's always telling you a story if you know how to read it, okay? Sometimes it seems like it's not, but it's always telling you a story if you know how to read it. It might be telling you that buyers are in control or sellers are in control. There's a signature for that with the boxes, okay? It might be telling you that we're in a trend day or a choppy day. Same thing. There is a signature, a box signature that's going to show up when that's the case. Or the market may be reversing or just probing a level. Same thing. The boxes are going to give us a clue to be able to see that. So we can read these clues. We can make sense of it. An example of this would be, it's a small chart, I realize there, but we've got a situation where we have stacking boxes. So boxes just keep creating and piling on top of each other. That I call that stacking boxes. But what that's telling us is this is a one-sided buyer control market. It's a trend day up. That basically means buyers are in control until conditions change. What you do not want to do is try to be a hero. You don't want to fight this. You don't want to try to step in and try to sell this and try to pick out the high tick of the day and be a hero. The evidence will show up when it's time. When the trend is over, you'll see that with the boxes. What you do want to do, you want to be looking for and being willing to take long trades, obviously. You want to be willing to hold for potentially a greater profit as opposed to a smaller profit. You want to be potentially more aggressive on your entry as opposed to less aggressive on your entry, okay? It's telling you that buyers are in control. It's a one-sided, buyer-dominated market, and until situations change, we're not going to fight that, and we're going to go with that, and we're going to make the most of that situation. Same thing here where we have stacking, selling boxes. Again, selling boxes just stacking on top of each other. That again is showing us that it's a one-sided, in this case, seller control market. It's a trend day down. Again, sellers are in control until conditions change. You do not want to try to be a hero and try to buy the lows, and you're going to get your head ripped off all day if you do that. The evidence will show you when it's time to adjust your strategy, but when you see stacking boxes like this, we're in a trend day. So we want to be looking for short trades. We want to be potentially more aggressive on our entry as opposed to less aggressive or more conservative. We want to plan for holding for a larger profit if it materializes as opposed to just locking in a quick profit. Again, the box signature is helping you make sense of the type of day it is so that we can make better trading decisions. Now compare that to a day like this where it's a two-sided market where both sides are in play, okay? We don't have stacking selling boxes. A box fails. We don't then have a stacking buying box. The market just kind of gets contained within these boxes, and it's a choppy day on the whole. Again, what is that telling us? It's telling us a couple of things. Number one, it's a two-sided market. Both sides, buyers and sellers, are in play. It's a consolidation type day. That means we're not going to want to go for trend-based trades or momentum-based trades. We either need to stand aside if that's your style, or you need to adjust your strategy and be looking for fade or reversal type trades, okay? Again, we don't want to get impatient. We don't want to force trades. We don't want to expect huge winners. Instead, what we want to do is be more conservative on our entry, be more risk averse. So instead of taking aggressive entries, we're going to take the more conservative approach. We want to be willing to, again, fade the market. In other words, buy lows of boxes and sell highs of boxes. Buy lows of boxes, sell highs of boxes. That's the idea. And we want to think point to point and take quick profits. We're not going for a huge move. We want to think, okay, I got in at the low of the box. I'm probably going to get out at the high of the box. That's sort of an idea. Here's another quick example of market reversing where you can see that we have stacking boxes. We start to see some sellers show up. We're now a little bit two-sided, and then sellers start to take over again. So you can see where the market started to, the other side started to come in, potential reversal point. It's confirmed with this box. So again, this is just kind of, again, the tip of the iceberg, but I wanted to show you some of that idea on the macro level. Now let's talk about it on a micro level, or more of an individual box level. The individual box, we're looking for the behavior of the market within an individual box. That then, again, you put enough of these boxes together, we have an idea of what the day as a whole is doing. So I hope that makes sense. Again, it's just a way of finding structure. So when we look at an individual box, again, these are just generic examples, we're trying to ask ourselves, when we have a box, that's essentially a containment area. In other words, if nothing else were to happen, or if no strong buying or selling comes in, the market should just kind of play ping pong and stay within the boundaries of that market, or of that box. It should go back and forth, just stay within that boundary. But when we do have a buying box, our first expectation is that the lower 15-20% of that should be an area of support. And if buyers are even reasonably strong, it should hold, and then we should head back to the high. Again, if buyers are strong, they're going to be able to accept price or get comfortable up above the box. And if they're really strong, they're even going to be able to continue higher with even better aggression and form another buying box. Again, now we've got a stacking box scenario. And what is that telling us? It's just, again, now we redo the logic. Okay, what should happen? Well, if buyers are strong, they should hold the low. If it's tested, they should go up and test the high. And if they're really strong, they'll accept price above there. And if they're exceedingly strong, they'll form another box above there, and we'll continue stacking. So again, within each box, we have an idea of, is this market meeting expectation or not? And that gives us a huge clue when we start putting it all together. Another scenario, again, kind of what I talked about at the beginning actually, was, let's just say that the buying box forms, buying the low of the buying box should offer us support. The buyers step back in like that, but instead of being strong enough to continue higher, instead of that, we test above and kind of reject, and then we come back inside of the box. So now there are a couple options. We're either going to go back down and test the low of the box and come back again, and maybe we'll come down, maybe we'll go up, but we at least know the decision point. Or maybe instead of that happening, maybe what happens is after we have tested the high of the box and rejected, maybe we come back down to the low of the box, and rather than rejecting, we accept below. And so again, how the market reacts around the edges of these boxes is really telltale. It's giving us an idea, and certainly when we put other clues together, and we'll talk about this in the scoring section, when we put other clues together, we have a better idea. Oh, in certain cases, we want to be a buyer on the low, we wouldn't want to be a seller on the high, and vice versa. Okay, so another scenario here, let's say we have a buying box, and again, our generic expectation would be that when a buying box comes in, if it tests down toward the low, we would expect the low of the box to hold and offer a support and send the market back higher. If that does not happen, and instead of the market moving back up, it rejects and sellers come back in, well, first of all, that's telling us that buyers are pretty weak and sellers are potentially strong. And if sellers are able to accept price below there, that's certainly a good sign for sellers. And if they're even stronger than that, they'll be able to form their own selling box. And then again, we have a situation where sellers are taking over this market. Now, will sellers come up and test their high and move back down and keep stacking boxes? Or will this reject? That's what we have to look forward to in terms of understanding the expectation. But the bottom line is that these boxes are giving you a frame to see what's happening, and that doesn't mean you're always going to take a trade at every edge of every box. Of course you're not going to do that, but when we have other evidence that comes together, we know that these box edges are huge decision points, and we know that if we are thinking about a long, that's a good spot to do it because we have a very small risk and we have a very nice reward even at a minimum, and vice versa. So I hope that makes sense kind of on a micro level. And again, within the idea of these boxes, that's just the tip of the iceberg. What you'll find that's beautiful is that when you start to use these boxes and start to understand them, which doesn't really take that long, you'll see that you're absolutely going to see the market much more clearly. You're going to know where you need to make decisions. You're going to know when a market is behaving as it should be, so to speak, or when it's not meeting expectations. That's going to give you a lot more information about what's to come. You're just going to trade with a lot more confidence because this logic works, and it's the nature of the market. It's how the market is structured. These boxes just kind of visually represent that. So again, the boxes, just kind of putting it all in context. We had aggression bars. Aggression bars help us lead to boxes. The boxes make sense of the market. From the boxes, we create trade entry opportunities. We don't want to just take every single one of them. We then want to score these trades using the 10-point scoring system to determine when we have a higher edge, a higher expectancy, or when we have a lower edge. Okay, lower score, higher score. It's giving us a very good clue in terms of what would likely be the best scenario for us on a given trade. Now, I realize I went through that pretty quickly. Obviously, in the member center, there's a ton of information, and we go over this in live sessions all the time. This will become like riding a bike. Don't misunderstand it, and you'll understand it incredibly well. So again, I just wanted to give you kind of a quick feel for this and how to understand this, or at least give you a sneak peek of what to expect. So if you have any other questions, or if you have any if that didn't make sense for some reason, just shoot us an email, and we'll get back to you. Otherwise, look forward to speaking with you soon. Thanks again.